All right. Anyway, thank you guys. And Peter, welcome back. Welcome back to
Great, Dale.
Facebook.
Thanks very much. Yeah, can you hear me okay?
Yeah, could hear you clearly. And if you want to share the screen, we just had some data,
Yeah.
and I'm interested in what your views are, and have some questions for you.
Okay,
So,
sure.
okay. Uh, would you mind if we started with the dollar?
Oh, sure, we can. Yeah, let's have a
Okay,
look.
because Peter, what I've noticed is the dollar's running the show. And it seems like it's all one market. When the dollar's strong, everything is under pressure.
Yeah.
We'll see. We haven't had the chance to really see, dollar weakness lifting anything, but it seems like the whole market is financialized, and even wheat and beans that have nothing to do with, Fed tightening,
Mm.
all have the same chart patterns. Uh, have you ever noticed the market being this synchronized um, before, where there's
Well,
no
I mean,
differentiation between asset classes or just magnitude?
I think this is a function of the inflation really, because I mean we've always used Elliott wave as a tool to cross-reference the different asset classes in order to gauge exactly whether a count is correct or not. This has been really useful. Occasionally, those correlations break down. I mean, a good example was really gold accelerating higher last year when the
With a
dollar was
strong,
going up.
yeah,
Because that was all about people getting excited about inflation, thinking back to the 70s, and thinking that gold would be a good medium for hedging that. And then later we got to March, we attempted the August 20 lows, gold started to drop, the dollar kept going up. And from then on, the correlation switched, back to its inverse correlation with gold versus the dollar. And I must say, actually, when it comes to currencies and the dollar index as a gauge, there's a couple of observations which and I'm sure everybody's picked up on, but I'll repeat them. And that is, first of all, that the dollar's really this strong on the basis of really two other real currencies which are weaker, and that's the euro and the yen. If you'd stripped out the weightings of the dollar index and the yen out of the dollar index, we wouldn't even be breaking the pandemic highs here. We wouldn't
okay,
be trading above that. We would be basically starting a new downtrend from that pandemic high, much the same as many of the other G10 currencies have done. We'll take a look at some others in a moment, if you like, just to make a
okay,
comparison look.
okay,
The other observation is that in order to time the exact high or get the price right in terms of where a peak of the dollar is coming, I think it's quite helpful to look at gold, because since March, that inverse correlation has gone back in sync again. We're not seeing the gold as an inflation hedge at all. I mean, look at poor old gold. It's dropped
yes,
enormously this year. We're down 20% or whatever. So, you're not going to. So what I think is that the correlation is the negative correlation has dropped back. And if we can be confident about a wave pattern for gold, which I think we can be, we'll come to that in a little while, then we can probably time the dollar.
okay. So more confidence in the gold count than the dollar count, and there's, there are times where I do have conviction about maybe a target or a level or something like that. And I wait for that level in that instrument and then extrapolate it to the other instruments that are related to it. So
Yeah.
it really only takes one good count to give you an idea of where everything else would go.
Well, exactly. I mean, that's exactly right. I mean, we do this every day when we if we want to look at the S&P, for example, and some of the data in the short term might be a bit messy. Then take a look at the Dow and maybe compare it to the NASDAQ. If that doesn't help, see if there's a really sort of clearly defined pattern in maybe something that's somewhat correlated, but not necessarily directly correlated. You might want to look at one of the European indices, for example, which we've been doing recently. In fact, it was only this week that we did make that comparison earlier this week and said, hey, look, the Euro Stoxx 50 has had 5 waves up from the previous week's lows.
Yes.
and it's in a correction. It's going to dig deeper this week, but which puts a sort of a rather finite correction limit downwards for the S&P. So you can always do that, and it's really useful. The more apt you are at practicing this, the better trader you will become. So anybody out there listening today, really honestly, I can't overemphasize the fact that you should really be looking at markets, no matter whether you're trading just one or two contracts, even if you're a specialist short-term stock picker or you're trading some of the indices, that you should really widen your horizon a little bit and make these comparison studies. They're going to really help you a lot.
Okay, so confidence in this count, a few different levels in the gold here. Time wise, is this going to stretch out to the fall, like the S&Ps may stretch out their correction to the fall or the end of the year?
Well, I think this is going to be completely different sort of correlation to what the S&P is going to do. I think this is more in tune with the dollar. I think this is telling us when the dollar is going to peak. Now, there's a necessity of 5 ways down from the March high. So I'm going to do a couple of ratios for everybody to have a look at. First of all, I'm going to extend 1 to 3. This is like 1, 2, 3 down here to 1789. I'm going to extend that by 61.8, which is the golden ratio. So that gets about 34.85.
Okay.
And then I'm going to use the inversion of 61.8. So that's 1618, just the inversion of that. And I'm going to extend the first wave right here by 1618. If I double click, it's going to project that for me. And you can see that they're coming in within a few dollars of each other.
Confluence, yeah.
So when we do see something like that, there's a very strong sort of pull towards those numbers.
It's a magnet.
Yeah. We've got some deeper levels. I mean, for example, I noticed that we saw some quite overshooting in some commodities just this week to the downside. You get sometimes, not very often, but sometimes you might get this number being overreached slightly in a one-day splurge of exhaustion. It might come down to this 1595 area, and then suddenly the next day you wake up and it's back above it. It's almost as if saying, hey, guys, I recognize this level as being really important. I've gone slightly below it. It was out of my remit, so I'm back above it again the next day. And that's when you get a classic reversal signature, and then you can start moving in. But I don't think this is going to take too long.
Excuse me, I'm sorry, Peter. All of this work is a 4, which implies after this bottom we should get a hellacious rally, right?
Yeah, I mean, I think that once we've got down somewhere down here to the 1684 number, 1684 number minimum, 16. What did I say? 16. Yeah, 1634 number. Sorry. Once we've seen that, we're getting a really nice flat pattern here, finishing for primary wave 4. Then we're off to the races. Then we can really start moving up, and all the bulls can go back in. And they'll have their day. At the moment, they're suffering, but they'll have their day. What I've done is actually, it's a bit of a plug, but actually it's relevant to the conversation, is that I know if people listening in, they like the sound of buying gold, you buy physical gold, that's always worthwhile. But I'm a great advocate for buying silver over gold, because I think the gold-silver ratio is going to narrow quite significantly.
Okay, we're almost at 93, 95 during this process, during this final stage of decline in both gold and silver. Where are we going to 100?
No, I don't think it's going to go that wide. You can see
we've already been there, right? 92.40.
Well, that was my target a little while ago when it was down here at 84. And so you can see we're just coming into it now. Here's the real-time data.
We're almost there.
We're almost there. That's quite a big retracement of the preceding decline. But you see, once that's going to top out wherever silver bottoms, basically. I mean, this is all directional movement. I mean, for example, when the ratio is narrowing like this, silver's going up. Okay, so this is the pandemic rise when silver was $11 something, going up to sort of $20.
Right.
And then this correction up is the correction down in silver since August 20. And the same for gold, since gold's been doing this flat pattern since August 20 as well. So once this tops out, and it's getting pretty close, it's going to start turning down, and then silver's going to be a big outperformer in the next 2 to 3 years. You know, we're going to go from, it's going to basically, you know, be outperforming gold significantly. But the interesting thing about this is that I think that platinum will outperform silver and palladium will outperform platinum.
And
that's
they're much
something,
weaker. They haven't turned yet.
yeah, palladium just started to squeeze up a bit. I just published our mid-year commodities video. I can give people details how to subscribe for that one at the end. But in there, I'm showing, you know, how the relationships are between gold and silver as this ratio you're seeing now, but also how silver and platinum looks. Platinum therefore would outperform, and then we can work out basis the ratios that we're applying on that exactly how far the underlying bullion commodity will travel, and that confers in with the actual targets that we have as well. So we're getting some pretty solid research done, which tells everybody that, hey, look, if you want to be a gold bug, why not be a silver bug as well? And if you want to be a silver bug, be a platinum bug. And if you're not used to trading palladium, then you might want to sort of have a look at a palladium ETF or something, because that should really be the big star performer.
Interesting. You know, Peter, I've noticed, you know, I'm long and wrong some miners, both gold and silver. And my silver shares that I'm in are holding up much better than the gold shares. I mean, they're barely making new lows with the recent huge sell-off in silver. I don't know if you looked at them, but I know you look.
The one I'm most familiar with is Fresnillo. You know, don't know whether you know that one.
I'm like in Endeavor, and I forgot the other one that I'm in. But
Fresnillo, I could have a quick look at that.
Fortuna.
Fortuna. Oh, I have got something like that.
But they have been acting a little bit better, and
yeah, I mean, this is Fresnillo on a weekly chart. It looks okay. It looks as if it's already finished its correction down here.
Yeah,
having a pullback now, but I mean, if this level holds, it looks good. You might, if you haven't already gone long of something like this, you might want to wait for a little bit of an uptick from a level above 610.80. That would give you a more affirmative confirmation that we're ready to start the next trend. But over the next years, you know, this can do a lot. I mean, yeah, you can see where we are. The price level today at 653, and we're talking about 3,500.
5 bagger. Yeah.
Yeah. I mean, that's you know, on an unleveraged basis. I mean, the stock market's not going to give you that in the last phase of the stock, you know, of the bull market. I mean,
right.
Once we get across this year, next year we start turning bullish again on the stock market. But it's not because of the depth of this year's corrections coming through. You're not going to get, you know, 5 multiples to the upside in the S&P or anything like that.
What do you think it'll be led by? Commodity stocks? You know, what's going to rally the market next year? I mean, the leadership for eons has been mega cap tech. Do you think that it's going to be things like Freeport McMoran and metals and you know, industrials?
Well, you'd like to think so, but to be honest, they're so highly correlated that this year, if we do get down to these numbers, this is my daily. Well, for those of you tuned into some of my work already, you might have remembered that we've been talking about this big swing down this year to something like a very deep correction. And we've been tweaking it here and there, depending on what's going on so far from the top. But otherwise, the targets are much the same. They're not that different. But I don't know whether there will be a leader or a lagger here, because they are pretty much correlated. I mean, normally you get correlations. If they are fairly tight but diverging slightly, they might diverge for a month, maybe 2. And it's always worth checking to see where the position is. I mean, obviously we use Elliott Wave to do that, which is very instructive, because I don't know of another technique that you might use to find out whether or not something's leading or lagging. I mean, how do you know when one is turning and the other is not, unless you're using something like Elliott Wave? Even an oversold condition on an RSI or something doesn't necessarily give you the exact numeric sequence of turning. So and certainly the fundamentals won't. So
I know, Peter, that you were also negative copper, and you're looking for about 30% decline, and it was more. It exceeded your expectations, actually, didn't it?
Well, there was we had a couple of counts in there, and one was well, I didn't want to frighten anybody. I usually work with the minimum expectations because yeah, we have quite a few clients in the copper industry, and
What, back to
but
50 cents when I was a young buck broker, under a buck?
God, yeah, well, it was in those days. Yeah, that
Yeah.
was. I remember those days pretty well. Let's see if I've got this. Yeah, well, I mean, this copper market. One of the things which is very important that's happened this month is that copper's actually broken below the 73.12 level.
Yeah.
And of course, that means you've got overlap in these price swings. So I think what's happening is that we're in a diagonal for primary wave C. This zigzag upswing from the financial crisis lows, we've had this pattern really since, well, for the last 11 years, it hasn't changed. But of course, you've got an expanding impulse pattern here in wave A. But in wave C, you've got this, what's now becoming obvious, is an overlapping diagonal impulse. And that's where you're allowed to see wave 4 overlap price levels of wave 1. Now, I think
So
we're very
perhaps copper runs more with the S&P. We get this X wave and a pop here, and then when the S&Ps roll over again, takes copper down again.
That's right. Yeah, we might even dig back. I put in 61.8%, but actually fourth waves can invariably be 76.4 retracements. So when we measure like this is the 61.8 area. We might even later be digging that deep and opening up the boundary line here a little bit. That won't matter. In fact, it probably might even look better. I think we're due for a low around December time. This is often when copper actually stages reversals. Had quite a few in the December sort of January time period before. So something like that could bring us down to these levels later this year, and then I think we'll get our fifth wave. But if we do that, it's an amazing upswing. If you go from 5.5 to maybe 13.5 or 3/4.
Yeah.
But
huge.
At the same time, you're not going exponential anymore. This diagonal will tell us that there's a finite limit, and also it's very instructive because the fifth wave within a diagonal has certain limits. So it eliminates anything going up to exponentially,
like
17,
silver
20,000
and
or
what palladium and platinum will do.
exactly.
So, yes. So it's in the precious, not industrial.
Yeah, it's not in the industrial metals really. I think they've had their, they're going to do well, but they're not going to do as well as the gold miners or some of the other precious metal miners. Or if you can be smart and get long of a palladium stock, that might be good as well. Things like that.
Uranium, Peter?
Yeah.
I think I asked you once. There are a lot of uranium players out there really being brought to light because of the energy crisis and a lot of countries deciding that they may have to go back to nuclear. And, there's been more and more participation in this uranium space. I see it a lot on Twitter, a lot of interest in it. So,
well, that's good because, I mean, we have updated uranium in our I'm showing you sort of
in
stuff
your mid-year?
Which is in our mid-year report. Okay, but okay. Well, let's have a look. I'll show you a glimpse of what uranium's done. This is going back to the all-time high here, but this is spot uranium prices. We think there's going to be another fallout here, drop this year.
Okay.
But that's purely because of an expanding flat pattern from 50.80.
So nothing phenomenal there.
Nothing phenomenal there. I'm a bit cautious with this final target. It could be higher, but I don't think it's got enough oomph to break into new record highs or anything. So that one, is
an industrial metal in a way, isn't it? Right.
Well, it very much is. Yeah, it's coming. It comes within that remit of industrialization and that sort of. So I think that it's not going to be quite as outperforming like the base metals. I mean, they're going to be good gains, but could you be looking at, if you want to leverage, could you be looking at something else? Now, some people are very familiar with maybe trading uranium on a spot basis or an ETF, and we've got a few in our report we've got a couple of ETFs on uranium. I won't show you those now because I want people to pay for the report, but But to be
I'm not
honest,
crazy about radiation, buddy. I had enough of it. But
yeah,
anyway, I wanted to also bring in that a lot of people are looking at what's happening in yields. And I think that you've had a little bit of a change of messaging on there where we thought that we were going to top, and then you saw this recent decline that's gotten you really constructive for higher yields.
yeah, that's right. I mean, at the beginning of this year, when we looked at the correlations again, we said, right, well, okay, if we're expecting the stock market to be a down year this year, and quite a big one, then we'll probably end up in a sort of a safe haven environment and yields pulling down at some point. So when we started looking at the overlapping sequence on a log scale chart with 10-year treasury yields from the pandemic low here at 37, pointing to it now on the bottom left, it looked very overlapping. We thought, right, well, this looks like a diagonal in a log scale chart. And if we're going to start talking about a big stock market decline this year, yeah, and the bond markets attract safe haven buying, it's going to pull yields down to maybe 1.5%, 1.75%. But when we started making comparisons recently, especially since the top in June, and looked at the way that the declines were unfolding, they were all basically corrective, and they weren't big enough corrections to substantiate those targets down to 1.75 really. They just weren't big enough. They were too small. Then we transferred our analysis to a log, from a log to a linear scale chart, which was similar to what we're doing already on a linear scale chart for the German Bunds and the yields there. And we realized that they were very similar in sync. So that adjustment had to be made. And that meant that really this downswing was just a minor correction within two successive upswings, which will have to develop probably into next year. This is a daily chart. I couldn't fit it all on one screen, but you could actually push out these parameters, into the middle of next year easily. I think at the moment, what I'm expecting is a bit of a range trading session for the next few months until the end of September, until the end of the Northern Hemisphere holiday season. So I think we're going to do something like this as a triangle before we go up sort of like year end and then pull back and then continue into the first half of next year. But it looks as if, that's going to continue up. And I'm wondering now whether we're going to be in a range trading session in the 10-year treasuries for, say, until September, the end of September. And that's going to keep the stock market running a bit higher. And then eventually, then we're going to get this next swing up, which is going to knock the stock market down again. I don't know for sure, because these correlations are a little bit unreliable.
Wonky?
Yeah.
That's the word Blake uses, wonky, a lot.
Yeah.
Anyway, what I respect is that, I've seen you change your targets and counts. I've rarely seen you change your mind about, what your, narrative and bias was. And that's what I thought it was important. And, really, I'm a big believer in, if you don't learn how to change your mind, you won't have any change left. And that's a big change for you. I wanted our viewers to be aware of it.
Well, thanks. Yeah, I mean, obviously, we can't just dig our head in the sand. If the evidence is coming up and saying, if you got to change, you got to change. I'm afraid that's it. I mean, you're right. We don't have to make those changes so much, hopefully. But a lot of our clients, they're major hedge funds and institutional pension funds, and of course, we've had a lot of dialogue with them since changing this at the beginning of the month in the last 2 weeks. So it's been quite an ordeal, but. The good thing is, I have to say that we've had some great feedback from clients, from some of the bond traders, and I think we've settled on the notion that looking at the evidence as it is, that we have to make those changes, and that it's unrealistic to hold on. The funny thing is, and I have to say this, and maybe anybody listening in might have caught up on this as well, is that here in Europe, all the bond market traders are so bearish. All they talk about is really recession in Europe. because of higher gas prices and everything. And you probably saw that the ECB had revised their economic forecast in the last 24 hours downwards. And everybody's so bearish. And yet these are the same bond traders who are not buying the bonds. Because if you put the stock market like for like against the bond markets, I mean, yields should be retrospectively a lot lower. If you believed in recession. I mean, if you really believed in recession, like the stock market traders are believing, the yields should be a lot lower, and they're not. And that's the stark realization that I came to. You know, I thought this decline from June, it's just not unfolding in the magnitude or into a five-way pattern enough for us to maintain much lower yields, much as we would have liked to, relative to the normal correlation with stock markets, but it just doesn't add up. So when I talk about the bond fund brief guys here in Europe, I'm saying to them, well, okay, you're talking the talk, but you're not walking the walk here, boy, because basically you're not buying the bonds. The yields are too high. You know, if you were thinking of recession.
All right, so just gut feeling, we've had a little pop here in Euro, but you think this could be another failing rally, and Dixie could maybe trade 111. Is that correct?
Yes,
and Euro could trade what all the parity people are going to celebrate. Where are we going to 98?
Well, I think it's I've had these sort of targets shuffled around a little bit, and but I must
could
admit,
that have been it yesterday, Peter?
Pardon?
Could that have been the low yesterday?
Well, it could have been, yeah, 99.52. It could have been the low. The only reason I hesitate is because of gold, because I'm pretty convinced that we're going to have a look at that 1634 number. And in which case, then I think the euro might just be in a sort of a fourth wave here.
Yeah, 103.20 is important. That was the historical breakdown, 103.50. So we don't get there, and we have one more wash out to 96. Okay.
Yeah, it could easily do that. And then the thing is that I think if you want to buy the euro or buy gold, you know, just keep a lookout at these two relationships. You know, they're positively correlated.
Thank you for edifying the community once again, Peter.
Yeah, it's a pleasure.
You want to show your website where people can get a hold of you and maybe check out your video on your update of commodity markets. You're talking palladium.
Oh, that'd be great. Let me just get. Let's have a look here. So here's wavetrack.com, and yeah, I mean, if you'd like to subscribe to the video series, actually at the top right hand corner here under news alerts, we've put in the mid-year commodities video update. Now this is part 2 of our series because we're doing a trilogy series. Part 1 is stock indices and a lot of different types of ETFs and equities in there. Part 2 is commodities. We just released that, so that's what we've touched upon today with things like uranium. There's a couple of ETFs in there, URNM, URA. We've also got some rare earth ETFs in there, which are really worth having a look at. But we've got the basics. And if you want to check and see what's in there, just scroll down to the bottom. You can see all of these contracts are in here. It's quite a big list and quite a few different equities.
You're covering kryptonite?
Kryptonite. Superman's kryptonite. It's
the only mineral you're not covering. So
yeah, we got the Wizard of Oz limited copper. You know, that's about as close as magic as we could get to, I think.
Yeah.
But if you want to, so the details there to subscribe to that or the stock indices stuff. And the part 3 will come out later this month for currencies and fixed income. And in the meantime, if you want to keep more up to date with the short-term sequences, then you can go into subscription and go subscriptions here. And this is the Elliott Wave Compass report. It's $39 a month. We publish 2 reports per week. And so that's about 8 reports per month. And we cover quite a bit in there, and you can see the subscription periods there. And there's no automatic renewal for this. So if you want to test this out and you don't want to have to You worry about having to renew or cancellations. You don't have to worry at all. It's going to cancel automatically after 1 month. You just pay your $39 and yeah, hopefully that will guide people through some of the major markets in there.
Thank you, my trading warrior brother.
Thank you too.
Appreciate your hard work and you sharing it with our community today, Peter, very much.
My pleasure. Thanks again for inviting me, Dale, and good luck to everybody at ForexAnalytix. I know Blake and Stephen particularly, and cheers, guys, and thanks again for putting this all together.
Peter Goodburn, everybody, at ElliotWave_WTI. Thank you, bro. Talk soon.
Bye,
All right, buddy. And everyone have a great weekend. Get ready for next week so you're not trading on the fly. And more than that, check out our community. And also, don't just count your pips, count your blessings. And I know everyone could find one. So how about the fact that you have money to speculate with? Is that a blessing? I'm not sure. Anyway, take care, guys. See everyone Monday.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.